What if I told you that the greatest financial war of our lifetime is being fought without bullets, soldiers, or even public declarations? A war where the battlefield is your bank account, where the weapons are invisible, and where the enemy you never voted for has more control over your future than the government you think is in charge. Because somewhere behind the official speeches and economic forecasts, behind the interest rates, the inflation numbers, and the money-printing jargon, lies a group of institutions that have quietly shaped the destiny of nations. They are the masters of monetary illusion, a network of central banks, supranational lenders, and financial engineers who discovered a century ago that controlling money is more powerful than controlling land or armies, and now, for the first time since their rise, a challenger has appeared. Not a nation, not a corporation, not a political movement, but a protocol, a mathematical ghost. A decentralized force with no headquarters, no CEO, no central office, Bitcoin. And what you are about to see is how these two forces collided, not in a moment, but in a slow, silent battle that has escalated into one of the most defining economic confrontations of the 21st century. This is the silent war between Bitcoin and the masters of monetary illusion. The origins of monetary illusion. To understand how we got here, we need to rewind to a moment when money still meant something real. For thousands of years, money was tied to scarcity: gold, silver, grains, land, labor. Things you could touch, things that resisted manipulation. But in the early 20th century, something changed. Nations learned that if you controlled people's perception of money, you didn't need scarcity at all. You could manufacture value with policy, could steer economies with interest rates, you could create prosperity or crisis with the stroke of a pen. They're the architects. The Federal Reserve in 1913, the Bank of England's redesigned model. The rise of the IMF and World Bank private banking dynasties, the Bretton Woods system after World War II. These were not villains in a movie, but they were the beginning of an illusion, a system where money no longer represented value, but confidence. Confidence created by central planners, confidence maintained by secrecy, confidence protected by complexity, and the illusion worked. For decades, until it didn't. How money became a tool for power after World War II, the world needed order. The US dollar was declared the global reserve currency, backed by gold, the anchor of trust. But behind the scenes, something else was happening. Governments wanted growth, banks wanted lending, politicians wanted re-election. All three realized they were limited by something ancient and inconvenient. Gold doesn't expand, gold doesn't bend. Gold doesn't care about political pressure. So in 1971, with inflation rising and foreign governments demanding gold redemptions, President Nixon made a quiet announcement that would reshape global finance. The U.S. was temporarily suspending the convertibility of dollars to gold, temporarily a global shockwave. That temporary suspension has now lasted over 50 years, and in that moment, the masters of monetary illusion were born. Because now money was no longer tied to gold. It was tied to trust. But who controls that trust? The central banks. With no gold constraint, money supply exploded. Credit became endless. Debt became a feature, not a bug. And financial markets ballooned into titanic machines dependent on liquidity. The illusion had reached full power. The world was now addicted to a type of money that could be expanded infinitely, without anyone fully understanding the consequences. The world discovers the cost of the illusion for decades. The illusion kept working, till its side effects became impossible to hide. Look at the patterns. 1970s, inflation crisis, 1980s, debt explosion, 1990s, deregulation, and speculative bubbles 2000s, dot-com crash. Then housing bubble 2008, the global financial system nearly collapses 2020, trillions printed in months. 2021 to 2024, highest inflation in modern history. Each crisis was bigger than the last. Each solution required more intervention. Each bailout created moral hazard. Each rate cut made the system more fragile. And at the center of it all was the same mechanism. Fiat money backed by nothing but confidence and enforced by policy. People began noticing. Why does everything get more expensive except wages? Why does every crisis end with the wealthy richer and the poor poorer? Why do governments always choose inflation over deflation no matter the cost? Why does debt keep rising while purchasing power keeps falling? The illusion was cracking. And cracks create opportunity. A protocol with no master then. In 2008, when trust in banks was at its lowest point in decades, something appeared on an obscure cryptography mailing list. A 9-page PDF, written by an anonymous figure or group called Satoshi Nakamoto. The title, Bitcoin, a peer-to-peer electronic cash system. What made Bitcoin different wasn't that it was digital. We had digital money for years. What made Bitcoin revolutionary was that it challenged every pillar of the monetary illusion. Scarcity, only 21 million coins, transparency, open ledger neutrality, no central authority, immutability, rules cannot be changed on a whim, self-custody, no bank needed global access, borders irrelevant. Bitcoin wasn't just money, it was a direct response, a rebellion against the idea that money must be controlled by institutions. It said, what if value can exist outside the permission of central bankers? What if inflation isn't a policy tool but a failure of money? What if financial freedom doesn't come from governments, but from math? This was the spark. And the masters of monetary illusion noticed. A threat to the illusion at first, Bitcoin was a toy, a niche experiment for coders and libertarians. Worth less than a penny, ignored by the world. But then, something surprising happened. People living in hyperinflationary countries began using it. People locked out of banking systems adopted it. People looking for an exit from fiat debasement started paying attention. As faith in traditional systems declined, Bitcoin's narrative grew. From 2009 to 2017, Bitcoin went from a technical curiosity to a global movement. Media outlets mocked it. Economists dismissed it. Central banks warned against it. Its price soared. And then, something critical happened. Wall Street entered the game. Not because they loved decentralization, but because Bitcoin became profitable. Institutional money legitimized the asset. Treasuries adopted it. ETFs were approved. Governments debated its regulation. Bitcoin was no longer a fringe idea. It had become a parallel financial system. A system outside the control of the monetary illusion. And that is when the silent war began. How institutions responded. Wars aren't always fought with violence. Some are fought with narratives, regulations, and strategic pressure. The masters of monetary illusion had 3 primary tools. 1. Narrative attacks. Bitcoin is for criminals. Bitcoin has no intrinsic value. Bitcoin wastes energy. Bitcoin is a bubble. None of these arguments were new. They had been used against gold too, but they shaped public perception. 2. Regulatory pressure. Governments began discussing taxes, bans, restrictions, exchange monitoring, surveillance requirements. Some nations banned mining, others banned trading. Others created strict compliance rules that made adoption difficult. 3. Competitive alternatives. Central banks started designing CBDCs, central bank digital currencies. These are not cryptocurrencies. They are the opposite. CBDCs give governments complete control over where money goes, how it's spent, how fast it circulates, whether it can expire, whether it can be frozen, who can access it. CBDCs are programmable money, designed to reinforce the monetary illusion, not challenge it. This was the counterattack. Something unexpected happened. The harder institutions pushed against Bitcoin, the stronger its narrative became, because every attempt to restrict it proved exactly why it was necessary. The system reveals its dependency. While Bitcoin rose, central banks faced a new problem. Their own system was becoming unmanageable. Global debt hit over $315 trillion. Inflation surged to multi-decade highs. Interest rate hikes risked collapsing entire sectors. In Europe, energy costs spiked. In the US, bank failures returned in 2023. In emerging markets, currencies collapsed at historic speed. It became clear the monetary illusion had entered its late stage, a point where debt grows faster than productivity. Money printing becomes permanent. Inflation becomes unavoidable. Trust becomes harder to maintain, and the system cannot tighten without breaking. Bitcoin, which had no central issuer and no inflation target, became increasingly attractive. not as a speculative asset, but as a hedge against systemic fragility. The silent war intensified. Why the system can't turn back every attempt to fix the system only made it worse. Quantitative easing, inflated assets, stimulus spending increased deficits, near-zero rates fueled bubbles. Bank bailouts encouraged more risk-taking. Monetary tightening created instability. It was a loop, a cause and effect trap. The same institutions that built the illusion were now trapped by it. Meanwhile, Bitcoin kept operating. 24/7, no bailouts, no central authority. Predictable supply, transparent rules, a stark contrast to the ever-changing policies of central banks. Repeating patterns, the public misses look at the recurring pattern of every declining monetary empire. Rome debased its currency. The French monarchy inflated the lever. Weimar Germany printed into collapse. Zimbabwe hyperinflated the dollar. Venezuela repeated the cycle. The mechanism is always the same. Rising debt, falling productivity, political pressure, money printing, loss of trust, collapse. Each time, a new system emerges. Bitcoin is following the same pattern that gold once followed. First, ignored. Then mocked. Then attacked. Then grudgingly respected. Then adopted. History doesn't repeat, but it rhymes. The rhyme is getting louder. The 3 takeaways. So what does all of this mean? Takeaway number 1. The monetary illusion is weakening. Central banks can delay consequences, but they cannot escape math. Debt-based money has a lifespan, and the cracks are visible. Takeaway number 2. Bitcoin is not just an asset, it's a mirror. It exposes the weaknesses of the old system simply by existing. Scarcity reveals excess. Transparency reveals secrecy. Neutrality reveals manipulation. Takeaway number 3. The silent war will intensify as trust in fiat systems declines. And as Bitcoin adoption grows, expect more pressure, more narratives, and more attempts at control. Every empire defends itself, even monetary ones. The real question isn't whether Bitcoin will win or whether central banks will prevail. The real question is, what happens to society when people start questioning the very illusion that holds the financial world together? Because once people stop believing in the story behind money, the story collapses. And when the story collapses, something new replaces it. We may already be watching that transition silently in real time. If you found this breakdown eye-opening and you want more deep dives into the hidden architecture of global finance, the real history behind money, and the coming economic shifts, subscribe, turn on notifications, and share this video so others can finally see the silent war hiding in plain sight. This was the silent war between Bitcoin and the masters of monetary illusion, and the story has only just begun.